that we're going to see another massive meltdown. And I've talked about this for about a year now. I believe that there's a 50 to 60% haircut coming to these markets. I can't tell you when. I'd be a fool to say when it's going to happen. But don't be surprised that one day you wake up and all of a sudden the markets are starting to head lower.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today, we're fortunate to have with us Todd Bubba Horwitz to discuss with us what seems to be a stock market melt-up, if we have a resurgence in inflation coming at us, if we should expect the U.S. dollar currency devaluation, de-dollarization, the commercial real estate crisis, and the breaking point for the consumer, and how this backdrop will affect gold and silver and other natural resources. Todd began his trading career in 1980 at the Chicago Board of Options Exchange, and he was one of the original market makers in the SPX Trading Pit, where he remains a member today. He's enjoyed a more than 4-decade career in the financial industry, and for the last 10 years, he's also been a mentor and educator to traders of all levels. He's a huge advocate of financial literacy, having developed a program for high school students. Todd is the founder of chief strategist of BubbaTrading.com. Todd, thank you so much for joining us today.
Gary, it's great to be with you. I look forward to it.
All right. Hey, let's start with the markets and the economy. What's your 10,000-foot view of the state of the markets and the economy?
The markets are totally ridiculous and the economy is horrible. I mean, we look around and yes, the markets are melting higher. But if you look at the average person, they're not doing very well. You have a inflation that is through the roof, no matter what the numbers are. And this is where the big problem is too many people buy into what they say the numbers are when they can't be accurate. I mean, when a box of cereal is $10 at the grocery store, who can buy it? When cattle is at all-time highs, who's buying the steak? I mean, again, you can't give me an excuse as to why these prices are where they are, but they are. And that's one thing we learned about markets is you can't fight them. But at the end of the day, there is no reason for what we're seeing here. The ridiculous pricing in indexes and equities. I mean, 7 stocks are driving the market. But at the end of the day, at some point here, this is more of a warning sign than it is good news, because we've seen this movie before, and I have traded on the floor through 87. I traded on the floor through the 90 internet bubble, and I traded through the floor in 2008. And these are all warning signs that are saying there are problems ahead, but we're trying to fool you right now. And that we'll see what happens from there.
Yeah. Well, talking about problems, I recently have had several Wall Street veterans like yourself on the show, Craig Shapiro from Leduc Trading and Gordon Johnson from GLJ Research. And they believe the Fed has not been restrictive enough, and that has led to this upsurge that we've seen in the markets that's going to likely end up in a blow-off top coming over the next 1 to 2 quarters. They're seeing signs of an uptick inflation as well. Todd, what's your take on the Fed stance? Has it been restrictive enough? Do you believe they should increase rates further rather than cut? And if they cut rates several times like the street believes that they will, what do you see happening considering where we're at?
Well, first of all, I think the Fed are a bunch of morons. That's number one. But that's besides the point. Let's get into the real fact of it. They're not doing anything, okay? And this whole rally was built on the potential of rate cuts. But if you look at the data, and if you believe the numbers are real, then they have to hike rates. They can't cut, okay? And I would see there's a more greater probability of a rate hike than a rate cut. And I think that you're starting to see this in the housing industry. Look at the mortgage rates now, 7.5%. Look at what's going on. And again, you can see whichever you want to see. And of course, we all look at a picture and you can interpret it what you want it to be. But if they cut rates, it's a political move, not an actual move to slow the economy, because they're going to make it hotter. And of course, we've gone through this with the housing bubbles, and I think we're entering or in the middle of or towards the end of another housing bubble. I mean, my own personal experience. I just bought a house. I swapped one house for a house twice the size, and the builder, brand new house, made a deal on the mortgage rates. To me, that says that they're in trouble. Not that they think that rates are coming down, but they're trying to get rid of inventory because they're stuck. And I think this is a much bigger problem. The Fed is way too active in talking I mean, I don't ever remember until the last, I don't know, 10 or 12 years when you heard about the Fed. I mean, you used to hear about the Fed once a quarter, maybe. Okay. But of course, Alan Greenspan, the original bubble builder who turned this Fed into what it is now, which is really crap. And because we don't get to audit them and because they have far too much control and now become political and not the private organization they're supposed to be. So I think the Fed has done a horrible job at managing this whole thing.
I do have a couple of questions for you on real estate, and I'm glad you touched on that, but I want to get back to what you had said just a moment ago, that the market is run by 6 or 7 companies. Todd, do you equate the Magnificent Seven or 6 or 5, whatever we're calling them today, with the .com or the Nifty 50 stocks? And do you expect to see a similar outcome at some point? Or is this time really different and the Magnificent Seven being a unique situation where these valuations are going to just remain stretched permanently?
It's never different. It's going to be the same result that we always see when it's done. When it's over, it will be over, just like every time in history in the past. You know, everybody forgets that the history of the markets, and that you can't make, if companies aren't making enough money to equate their valuations, they're going to eventually melt down. Now, how long can it last for? Nobody knows the answer to that question. Anybody who says they know the answer is ridiculous. Okay, at the end of the day, this will crack again, because again, you can't have all money pouring into one side of a market and have these things go to Pluto. I mean, look at SMCI, some computer company that went from 300 to 1200 and now moves around 150 points a day. This is almost identical to the internet bubble, and it's going to collapse. And again, these are the signs that you're watching right now. You know, everybody forgets the overvaluations is one sign. The separation in economy, you know, from the very rich to the very poor, because now the middle class line, let's say, was here before, now it's up here, right? So there's people that are struggling that can't support these. I mean, the overall investment community is about 15% of the population. So again, we've got problems, and you can try to ignore them all you want, but when you have too much money in the money supply and you've got people that can take advantage of it, they're going to continue to do so. And that's why the rich always get richer and the little guys always get stepped on.
Well, and that kind of is a perfect lead into what I was going to say. And that is, you know, most financial advisors today are saying, just stay in the market. Everything's gonna be okay, even if it drops down. But, you know, during the .com bubble, it took 14, 15 years for it to get back to nominal par, let alone inflation adjusted. I don't even know how long it took. So, you know, the little guy is going to get crushed here again, and we need to get this information out to them. Most of them are just listening to the parroted line, don't you think?
I agree. And I am a believer in the market and staying in the market, but again, it's not a believer in trying to jump into these high flyers and chasing stocks up. I'm a believer in good, solid companies that you have the opinion that they will be in business for the next 20, 30, 40 years, right? I mean, again, any big company that you invested in 30 years ago went through all these collapses, you were fine. You made a lot of money. But again, if you start trying to play these high flyers that don't make any money, like the .com bubble, you know, most of the people in the .com bubble made a lot of money, then they lost it all, and that they didn't account for is the tax dollars that they'd have to pay after it was all said and done, because it's all tax money on those dollars. So again, this is the classic chase the market around versus investing. If you're truly investing, you're buying good, solid, hard companies that, yes, they'll go down. And I am a believer. I mean, I actually have a hedge program, so I'm never out. I'm always long the market and hedged it to a mathematical certainty. But at the end of the day, I would tell anybody, if you're buying good companies, I'll say Apple, whatever, AT&T, whatever the good companies are today, if you're buying those, the market says 8.5% year over year since the inception of the market. And I think that continues. However, when we get these big blast off type moves and you get a few stocks that are driving the markets and now we're looking for new, I think that's where the market ends and that's where the problem begins. And because most chase the hot stock, that's where they end up, because everybody wants the excitement, not the 8.5% year over year.
Yeah. So how do you see the fast developing robotics and artificial intelligence tech companies impacting the markets and the economy?
I think it's not so good. I think it's a bad situation for the economy. Look, I'm all for some technology, but you know, this is not like the Industrial Revolution. The first we had when anybody could switch to any job. we have so many people that are older that aren't capable and just switching into using AI, using technology, using computers in a way that are effective and beneficial to society. So I think that this will be very ugly until we get people trained. And we have not, like everything else, we have not done a good job in this country training people to prepare them for what the upcoming things are coming. And I think that's a big problem as well, because I think you're going to see a lot of unemployed people. The more technology takes the place of people, the more unemployment we're going to have, which is going to be a much bigger problem.
Yeah, I mean, that's going to be a problem for the federal government to, when you talk about unemployment or you talk about some of the other social programs when we already are running a huge debt and deficit.
Well, then they're going to continue to build that debt deficit. They don't care. This is a way to destroy the freedom of the American people. This is a way to turn this into a Marxist or a communistic country right now. This is more the plan of what I think of the administration that's in power now. And of course, if you look at the squad, they want to give everything away for free. I'd like to turn the United States into an island and go back to being by ourselves, because we can supply ourselves. We are self-sufficient, but we've decided to give all of our jobs and everything else away to everybody else and open up the borders, which is another thing, another story for another day.
So, going back over the last 50 years or probably more, when the yield curve inverts, there's been a very strong correlation that a recession was coming. The yield curve inverted back in October of 22 and has been inverted ever since. Should we no longer be paying attention to this metric? Because I'm hearing people say that it no longer matters.
Well, it always matters. And again, remember, the correlations and the markets and everything that goes along with it doesn't have to correlate exactly today. And what has already been priced in ahead of that before we go. Big market meltdowns don't just start, like I go back to 1987, okay, when I first went through my first crash on the trading floor. It didn't just show up. The markets were in trouble from August of that year, and it culminated in October. In October of 2008, we were in trouble for a year before that. There was a lot of warning signs. And when Paulson came out on Face the Nation and said the banks are in great shape, you knew there was a problem. This is the same story as when, if you're a sports fan, the coach gets the vote of confidence, your job is safe, and they fire him in 3 weeks, right? That we're going to see another massive meltdown. And I've talked about this for about a year now. I believe that there's a 50 to 60% haircut coming to these markets. I can't tell you when. I'd be a fool to say when it's going to happen. But don't be surprised that one day you wake up and all of a sudden the markets are starting to head lower. And it'll start with a sell-off. And it may be right here. We're at a very key point in the markets right now. Now, is it going to be this week? I don't know. I don't. Again, it could be 6 months from now. The big caveat this year is that it's an election year. Mm-hmm. So, markets other than 2008, the only market I can remember in my lifetime down in an election year was 2008. So again, you've got a Fed that is much more active, that can do a little bit more manipulation to force pricing. So we'll see.
So, you're not the only person to come on the show that has said, I'm expecting a big crash at some point. This thing is melting, and then it's gonna go. My issue with the idea of a crash and staying in the market is that when it does happen, there's a lot of people who don't have 10 or 15 years for that nominal value to bounce back. But, there's the 13-week moving average insider buy-sell ratio has now eclipsed the level that we last saw in the fourth quarter of 2021. And that preceded about a 25% drop in the S&P 500 and more than a 35% drop in the NASDAQ. And I'm sure you're very much aware that Jeff Bezos of Amazon has highlighted this by selling $6 to $7 billion worth of his stock over the last few weeks. Todd, what is this insider buy-sell ratio telling you?
Well, I mean, look, again, we're at a position that, the street, the people on the street are always the last to know that there's a problem, or the last to believe that there's a problem, right? Because again, as long as right now I'm still making money, I'm happy. And then you get to that point where you get the first pullback. And of course, in 22, we did get the pullback, but then we got the rally back after it. Okay.
Right.
So it wasn't a disaster. One of these times we're not going to see that bounce back. Go back to COVID. We had the big sell off in the COVID, and the markets immediately bounced and obviously charged to ridiculous highs now. So, but one of these times, the buying the dip mentality is not going to work, and the chasers are going to get chased out and be busted once again. And
Yeah.
again, I don't know when that will be, but I think we're getting closer with every day, with everything that we see. If you're watching what's going on in the food industry, look at the grain prices. Grain prices are virtually at zero. In fact, I play poker with some farmers in Las Vegas where I live, and they're telling me they're not going to plant this year because they can't afford to plant because they're going to have to plant at a loss. Yet you go to their
Wow.
grocery store, and as I said, a box of cereal is $10. Well, you're going to have potentially a food shortage coming because these smaller farmers aren't going to be able to plant. So you put that in combination with everything else that's going on and the high cost. And yes, these markets will find a point in where they'll, after the people are delusional, which is what they are right now, that they'll chase them, and finally they'll throw in the towel. And of course they'll be lined up their brokers trying to get out of everything as the markets are collapsing.
Yeah. Wow. Warren Buffett, to your point about this eventual collapse, there's going to be a lot of things that are going to be on sale, I would imagine, like they have in other collapses. Warren Buffett's Berkshire Hathaway reported a record $167.6 billion cash balance in the fourth quarter of 2023. I'm sure you've seen this. Everyone is now asking, why is Buffett holding so much cash? What's your perspective here?
Well, I mean, listen, Buffett can see the tape. He can read what's going on. He understands the news, even though I don't really care for him, but he understands the markets and he understands what's going on. And he knows, just like what happened in '08 when he loaned money to Goldman Sachs, not only did he get preferential treatment, but he got a 10% bonus on top of everything else. So he'll be there to hand out the money, and whatever he's not making today, he'll make in spades tomorrow. When it's time, he will get paid off because he'll be buying all these companies and be getting preferential treatment and be getting not only the stock, but getting a little bit of a bonus on top of the loan to help them survive. So he's preparing for what's going to happen. And, again, you can argue with him and not like him, as I don't. But again, I can't take away his knowledge or his investing acumen and understanding that the guy who's got the money when it's time to step in is the guy who's going to do the best throughout all this. And I think that's where he's sitting. And I think he's prepared because he realizes, and he said in the 90s, there is no new economy, old economy. You got to make money. If you don't make money, you're not going to survive.
Interesting. All right, let's talk about the debt that's maturing this year. There's about $7 trillion, I think, in debt maturing in 2024. And we're on a $3 trillion deficit run rate. So, we're talking about 10 trillion in new debt that Janet Yellen has to issue this year. Todd, is there enough buyers for this 10 trillion that has to be issued this year? And if not, should we expect a currency devaluation?
Well, I don't think there'll be a currency devaluation other than the natural criminal acts of the manipulation of the currency to begin with. The minute we went on the fiat currency system without anything backing a currency, that was the end game, right? That was, well, we can do whatever we want now. They're not going to devalue, but there's plenty of demand for our debt. Why? Because, of course, the biggest debt holders are going to be forced to take on United States debt. Otherwise, if we devalue, you're devaluing against China, you're devaluing against the big debt holders already, and they're not going to let that happen because, again, they'll get wiped out. That's why when everybody gets concerned, there's talk, China's going to sell our bonds. So what? Let them sell them. The Federal Reserve can liquidate our currency anytime they want. They can devalue any day they want. If they decide that it's time, they can stick it to all the big debt holders. It's the old story. When you owe somebody 5,000, they own you. When you owe them 5 trillion, you own them. And I think this is exactly what the story is. So to me, there'll be no devaluation. To me, the buyers are going to have to buy. They're going to be forced to step in and buy because it's all a big Ponzi scheme anyways. When you look at the overall picture, look at the debt globally, okay, everybody's in on it. All the central banks have been in on it. And of course, the whole central banking system is a Ponzi scheme to begin with, to start off with.
So what do you see in terms of purchasing power? Do you see purchasing power loss versus real assets taking place?
I think we're seeing that right now. People don't get it. I don't understand it. I look at, I go back and I go, okay, 1985, I made X and I lived a hell of a lot better life and I make 20 times X in 2024. But yet my buying power is nowhere near. I can't have the same life that I had then. I think that we've got a terrible traumatic area here, and you've got so much debt from the consumer. forget about the number of how much consumers owe, because again, inflation is, it's hard to calculate. But the one important number to remember is that there are more households that have at least one credit card at limit that they can't pay off, and they're paying the minimum on every month. They're never going to get out of debt. Okay. And of course, because of the strong credit card lobbies, those debts are not dischargeable through bankruptcy. So what's going to happen? And people are still spending and spending because they got another credit card. Because of course, the credit card companies, knowing that they have no real risk, can issue more credit cards, because at some point they're going to get paid. And if you ever understood the math behind banking and behind all this other stuff, all they're really doing is creating new money anyways. And they don't have to get paid back by everybody. They only need to get paid back by 25% of the package to make profits.
Todd, do we have the political climate at all where either this current Congress and administration or the next one can repair the entitlements, balance the budget, stop the war spending, et cetera? Or, what happens here? Are we just on this long-term
kick the can down the road forever?
Yeah.
Apparently listen, it's been happening, and we can talk about 30 trillion and whatever the numbers are. But again, if we look at the numbers in general, they continue to grow up every year. Okay. If we lived like Congress or the government lived, we'd be either in bankruptcy court or jail.